Options Trading 101. Is it basically betting? Many people think that options trading is considered gambling. This is because there are some trading plaza like GameStop, Reddit, where all they do is high-risk trades that are not appropriate for an average person. Hence, people build up misconceptions that options trading is gambling. That is why in this video, I want to share with you my idea with regards to options trading and why is it gambling or not. Either way, hello everyone, this is Finance Boss, an awesome channel for awesome people like you. And if you're new to the channel, don't forget to click the subscribe button below and share this video. Is options trading gambling? Obviously, if options trading really was gambling, I wouldn't be doing it, let alone talking to you about it on my channel. Like, hell no! But the thing is, it actually can go both ways. There are many different styles of options trading, and depending on how you do it, it could be considered gambling. Buying and selling options are just like buying and selling stocks. There are people who treat the stock market as if it were a casino, not a good idea, and they make and lose a lot of money in a short amount of time. And then, there are people who treat the stock market like a real legit place to invest your money for the long term, such as Warren Buffett. So it all depends on how you approach things. You know what I mean? To me, for something to be considered gambling, your success has to depend purely on luck, as the outcome is all based on chance. The type of options trading that is most closely associated with gambling is the type of options trading that happened with GameStop. So back on January 2021, a bunch of people in a Reddit forum called Wall Street Bets joined forces, bought up a ton of call options on GameStop, and drove up the price from $17 to $500 in less than 30 days. So when you buy a call option, it gives you the right to buy the underlying stock at a predetermined price, also known as the strike price. And if a stock goes all the way up here, but you have a call option that allows you to buy the stock all the way down here, then you'd make a big fat profit on that. So that's kind of how call options work. A short squeeze happens when a stock's price starts going up rapidly and forces players who bet against the stock to cut their losses and exit their positions. When you bet against a stock, that's called short selling. When you short sell a stock and it starts to move up in price, you have to buy back the stock at a higher price than where you sold it in order to close out your position. This results in a lot of panic buying and it drives up the stock price even more. So, it's this really vicious cycle where you're losing money, so you need to buy back the stock and that drives up the price even more, and that's why GameStop moved up so quickly in a short amount of time. It's essentially the opposite of panic selling. Think of it as panic buying. You have to multiply everything by 100 whenever calculating the dollar amounts involved. This is called the contract multiple. And so, going back to this GameStop call option, if you want to buy it, that means it would actually cost you $2,685. Not only this, but options all also have an expiry date. So if GameStop isn't well above the call option strike price of $175 by the August 20th expiry date, you'll lose your entire $2,685. So, not only do you have to get the direction of the stock price right, but you also have to get the timing right. There's literally no margin for error, a very small window of time to get it right, which isn't great because you're already starting off $2,685 in the hole. I mean, if you understood the company, well, you could certainly predict a reasonable confidence whether the stock will go up or down and roughly what price it might be at over the next 5 or 10 years. But to predict what will happen over the next 30 days and to stake $2,685 on that, it really sounds like buying a lottery ticket to me. In other words, huge potential payoff, but very low probability of success. If you buy this lottery ticket or call option, other than your hunch that the stock might be going up soon, what edge do you have over any random person who is planning to buy this call option and is also hoping to get rich quick? Newsflash, you don't. This is why buying options allow GameStop and Wall Street is basically the same thing as gambling, and it's not an activity that I condone. Okay, then how does one trade options in a way that is not gambling? So glad you asked. The answer is to be a net seller of options and to do it in a risk-defined way. So let me explain. You already know why buying all the options is a bad idea. They are expensive, hard to get the timing right, etc. So, if buying options is a bad idea, then since selling options is the opposite of that, selling must be a good idea, right? Yes, but only if you do it a certain way, because selling options can be extremely risky too, and in some cases, even riskier than buying off. Because when you sell a call option, you're actually exposed to the potential for unlimited losses. Because if you buy a call and this is what you make when the stock price goes up, then selling a call is the opposite of that. That means that's what you could lose as the seller of the call option. For every dollar that the stock price goes up, the buyer of the call option would make a dollar and their profit would just keep going up. And the call seller would lose a dollar and their losses would get even bigger as the stock goes up. And since the stock can keep going up and up and up in price, potentially to infinity, then your loss as a call option seller can also theoretically go to infinity. That is not a smart way to do things, which is why, instead of just selling a call option, you want to do something called an option spread. A spread is whenever you sell the option and simultaneously buy another option for protection. A good way to understand option spread is to think about insurance companies. I don't know if you already knew this, but in the insurance business, there's also something called reinsurance. Reinsurance is when insurance companies buy insurance from other insurance companies in order to limit their own exposure in case of disaster. Let's say you have a car insurance policy with Geico and your car gets totaled. So obviously, you'll hit up Geico with a claim to replace your car. Say it's $20,000 and Geico is going to have to pay you $20,000 because that's what insurance companies are supposed to do. Now, imagine if Geico also hits up their insurance company and puts in a claim for say $15,000, then that would mean Geico is only on the hook for that $5,000 difference as opposed to the full $20,000 because they have $15,000 worth of protection from their insurance company. To connect this back to options trading, selling a call option without buying another one for protection is kind of like Geico selling insurance without also getting their own insurance to cover theirs. This is called a naked position because you would be exposed to potentially unlimited losses. Like in this example of Geico, if the car insurance claim was $100,000 and they didn't have reinsurance, they would be on the hook for all of that. On the other hand, selling an option spread would be like Geico selling insurance while also getting reinsurance from another insurance company. This type of trade is the bread and butter of my options trading side hustle because you can collect money up front, but it's also safe in the sense that your risk is limited to an amount that you can control. To use options trading slang, this trade is a risk-defined trade. Anyway, with this approach, your trades would look kind of like modest but consistent gains with occasional but manageable losses. Compare this to buying options, where your trades would look more like huge but occasional gains, but mostly just a lot of consistent losses. One of those looks a lot like gambling, whereas the other one is a lot more reliable and looks like an actual business. So, did you learn something? I know this may be a lot to take in because of the many information, but it all comes down to this. Options trading may only be considered gambling if you make a profit that is heavily dependent on luck. Whereas, if your success is based on actual strategy, that kind of options trading is not gambling. I really hope that you learned a lot from this video, so please comment down below your takeaways. Don't forget that if you want to be successful in life, never depend on luck, but work your way towards the top. Once again, subscribe to the channel and click the like button for more. This is Finance Boss, signing off.